It's our it's our concluding week of week number 8 of Business Biz 630 Corporate Finance. This is Professor Hassey, and for just a couple more videos this week, and then we're all done with our corporate finance class for this fall session. Two main priorities this week, or let's make that three. First priority is if you have yet to post case number 3, please do so by Wednesday. I will be posting the case 3 grades on Thursday of this week, so you can get a good idea where you stand in the course heading into the last evaluation or last assessment, which is the electrics case, which is due Sunday, December 18th. Again, there are no extensions for that because the grades need to be posted in the next few days after the 18th, so no extensions for the electric case. I'll be having my student hours Thursday evening at 6 o'clock. Should any of you have any last minute questions, and a lot of you are sending me emails during the week, which I'm trying to get back to you as quickly as possible with your questions. Course evaluations, and the link is in Blackboard, and I'll show you that in just a minute, are due December 20th. And the final course grades are posted to Blackboard on Thursday, December 22nd. So that's our timeline this week. We're going to be talking about the electrics case today in this video one last time, going over a couple of main points that a lot of students are asking me about. So we're going to go over that. Please, if you have not done so, please look at the review session video of the electrics case, which was posted over the weekend. That can be a very helpful session for many of you. And in our next video will be Thursday to go over case number 3 and also talk about the alternative capital strategy of leasing, which is chapter 19. Even though we're not going to be assessed in that in any of our work, so you won't be responsible for rehashing that in any type of case study, it's an important alternative to capital strategy that you should be aware of, and we'll talk about that in our Thursday video. But let's get back to a couple of key questions about the electrics case. Okay, before we get to the electrics case, just one last thing, a quick run through our Blackboard to make sure everybody knows where everything is. First of all, in the course syllabus, calendar, and information section, there is now the evaluation link. And I know I've been harping on this a little bit about course evaluations, but it's very important. It makes our programs better. If you're unhappy with a class, unhappy with a professor, if you like a professor, if you like the class, if you don't like the technology, if you like the technology, please let us know, because it makes the MBA program stronger. And our reputation and our brand gets stronger, which helps you in the job market, helps you. And when you say somebody, oh, you went to University of Laverne and got your master's. Oh, I hear that's a good program. So that's why we do the course evaluation. So once you're done with all your work, please click on this link and complete the evaluation. It's anonymous. It doesn't affect your grade whatsoever. The results of the survey or the evaluation are not posted until February. So it's just a tool for us to use to make our program better. So please try to do that if you can before the end of this course by next Tuesday. And again, also, if you go to this section also, it's a final timeline of our class. And just so you remember, for some of you, our assessment paper is 25% of the grade, course evaluations, and final grade posting, just so you have all that information and available to you to complete our course. Now let's go to the electrics case. One of the key questions I've talked about in this analysis is that I've received from a lot of students is, first of all, the cost of capital, weighted average cost of capital calculation, and there's a little curveball in there, and that's what I'm going to talk about, and also the warranty calculations, which I think I pretty well covered in our review session. But one last area is the risk analysis, the scenario and the sensitivity analysis. I'm going to talk a little bit more about that today. But first of all, in the weighted average cost of capital, let's bring up the electrics case so I can show you. In regards to the financing and setting up the capital structure for this weighted average cost of capital, as you all know, the weighted average cost of capital, or the discount rate that you use in your capital budget analysis to determine discounted cash flow, is calculated by taking the weight of the percentage of debt and equity in the capital structure times the cost, the after-tax cost of debt, and the cost of equity being calculated by the capital asset pricing model. Boy, is that a mouthful. Well, as you notice in the Exhibit 4 of financing, it says the following. The following assumptions are used to determine the cost of capital. Historically, the company tried to maintain a debt to equity equal to 0.50. This ratio was used because lowering the debt implies giving up the debt tax shield, and increasing it makes debt service a burden on the firm's cash flow. In other words, their debt to equity relationship is 50%. That is not the capital structure of this company. The capital structure of this company is not 50% debt, 50% equity. The capital structure of this company of debt to assets and equity to assets, you have to determine by knowing that the debt to equity relationship is 0.50 or 50%. That gives you the clue to determine the capital structure of this company at this desired level. So there's a helpful hint for you. So the capital structure is not 50-50. It's something else that you need to figure out. In addition to that, if we go to our questions on page 3, or excuse me, page 4, we are told that in question 6 that you use the average demand scenario to evaluate the sensitivity of the net present value with respect to the sales price of the electric motor and the cost of the controller. So those are two variables. In case number 2, as I mentioned in our review video over the weekend, you had 3 variables in your sensitivity analysis: selling price, variable cost, and fixed cost. Here in the electrics case, you have 2 variables: selling price per unit, just like you had in case number 2, but the other one is a different variable, and it's the cost of the controller. And remember from our work and discussion in this, the cost of controller is made up of 2 costs: the cost or the price of the controller and installation, which is $1,280 for the CTX13 model and $1,260 for the MT78 model. But then there's another cost of the controller, and that's the 5-year warranty at $90 a year for 5 years for the CTX13 and $100 a year for 5 years for the MT78, which you'd use the discounted net present value of those 5 years to determine your variable cost per unit, every year. So the combination of the cost of the controller and your variable cost per unit cost of your warranty over those 5 years, those combine to be your variable for the cost for the sensitivity analysis for your cost of your controller. Hope that helps you a little bit. Some students are having a difficult time with that. So please note that in your work. Okay, remember you have the ability to send me a draft of your work of the electrics case, of your base case analysis for me to review and let you know you're on the right track. But remember, as we get closer to the weekend, many students will be demanding my time, and my feedback time of getting back to you will be reduced or be exaggerated because of the quantity of the work I'm doing. But if you'd like to send me that, please do, and we can review that. Again, our subject in our Thursday video will be this section from week 8 in our Blackboard lease financing. One of the advantages, especially for small business, is instead of acquiring assets because they're expensive and they don't want to borrow the money and they don't have the ability to borrow the money for expensive assets like computer systems, telephone systems, and the like. Leasing is a very good alternative to, especially for small businesses, to lease the asset. The only disadvantage to leasing is you do not have the tax deductibility of either a loan or a depreciation on that asset. But leasing gives you the alternative of having the asset and still using it to create revenue. And there's a nice little spreadsheet that we'll look at that's included in the review notes here. It gives you a better idea. And also for some of you who are thinking about getting into the real estate markets down the road or investing in real estate, lease financing and the spreadsheet accompanied by that can give you a good alternative of reviewing real estate investment. And I'll talk about that in our Thursday video. So again, Electric's case, keep trucking. I'm around all week. So if you need any questions or answers, also remember our student hours are Thursday evening. Have a great week, everybody, and we'll talk to you soon. Bye-bye.